All right, what's going on? Andy Fry here from Pronto Tax School, and we're going to talk in this training video about rental income, QBI, qualified business income consideration. So I can only imagine how excited you are to hear that topic. And if you've ever felt like when you're dealing with rental income and the QBI deduction, it's like if I'm being honest, I just kind of start checking some random boxes and I'm not quite confident in exactly what I'm doing with regards to rental income QBI. This will be a great training video for you, I hope. And even if you are confident in dealing with rental QBI, I want to see if we can drop a couple little tidbits of knowledge with you and just be in that dialogue with you as a fellow professional and make sure that we're really optimizing the QBI deduction for our rental income clients. So if that sounds good to you, let's look at those random boxes in question, right? What are the random boxes that I'm talking about in terms of sometimes, the feeling like I just clicking random boxes, not sure what the implications are. Okay, so this is an example from Intuit Lacerte software where there's different boxes you can check, SSTB, this rental real estate enterprise number if claiming safe harbor, W-2 wages allocable to business income, etc. So depending what of those boxes are filled in or checked or have numbers inside of them can change the treatment of the rental income. So a Schedule E, right, a rental income, whether it is eligible for the QBI deduction, whether you get the QBI deduction or you don't, and it can start changing around a lot of numbers on the tax return, as you know, if you have already tried checking these various boxes, right, or putting numbers in them, right? So let's go through some of those boxes in a bit more detail and make sure that we really feel confident with how we are treating any particular client's rental income with regards to the qualified business income deduction. And so this is a little cutout, and you may have the knowledge base in the software that you're using that shows you like is rental income. So when you put in Schedule E income, is it automatically counted as qualified business income and meaning that it's eligible for the qualified business income deduction of 20% of that income? That's a pretty, a good deduction, right? 20% of the net income. That means you're only paying tax on 80% of the income, which is obviously better than paying tax on 100% of the income. So in theory, it's actually desirable that rental income would be qualified business income. So if you haven't already done this, and you probably have, but like just check the setting in your software as far as like Lacerte automatically is going to treat any income you put in Schedule E as not qualified business income unless you tell the software that it is qualified business income. So you want to know for sure how your software is doing it. If you don't check any boxes, how is your software handling it? So definitely start there. And, just from like a tax law point of view, right? Like, is rental income Section 199 eligible, right? Does it count as qualified business income and is eligible for the qualified business income deduction? And this is a good article here from the tax advisor, and kind of the upshot of the article, or the summary of it would be that it does qualify as qualified business income if it meets the definition of a trade or business under the Internal Revenue Code section 162. Okay, and so 162, what's interesting about it is it doesn't really provide like a spelled out definition of what is a trade or business. There are only court cases that have kind of established like, okay, this is what a trade or business looks like, and here's kind of the key tests that we generally will use to determine if something is a trade or business. And when in doubt, or what those tests are, is number one, a good faith intention to earn a profit. So if we think similarly to like a hobby, right, you really have a profit motive, right, determines whether you have a business. And then number two, do you engage in that activity on a regular and continuous basis? And so most rental income for like smaller landlords, right, will meet that definition, right, pretty easily. But others, may not, right? They may be like a managed investment, and that's why some people are saying like, hey, like a triple net lease won't qualify for QBI, or maybe it does qualify for QBI or not. But the way it kind of has played out in practice, as the first couple years of the QBI deduction have played out, right, is to say that, you can use rental income as qualified business income if you want it to be. And, if you're in doubt, these are kind of the tests that you'll apply under IRC Section 162. So that's kind of the big picture of it. And there is a kind of an easy override option, right? And you'll have something similar in whatever software you're using, where you just basically check a box, or tell your software, hey, I want to count this as qualified business income, it's rental income, and please do count it as qualified business income. There's also the option to kind of protect your classification of that rental income as qualified business income by using that safe harbor election. Okay, and that you can read more about that in IRS Notice 2019-07. Not actually required that you do this, but it is kind of an extra step that you can take, saying that the taxpayer spent a certain amount of hours per year on the activity. And they have separate books and records and kind of other things that will really prove that the taxpayer has a trade or business in their rental real estate. So that's an option as well on the tax return. And unadjusted basis immediately after acquisition, right? It's like the type of thing that, as much time as we've had to look at trying to study what is that UBIA, right? It never seems to matter, right? It's just thank God I studied 30 hours trying to figure out what UBIA is, because I'd never see it on any tax returns except on related to rental income, because of the price of the real estate, right? So it actually does matter quite a bit in some cases. So if you have a profitable rental, so a Schedule E that's yielding a profit, the UBIA consideration, if the taxpayer has a higher income and so they're over the threshold amounts for the QBI deduction where it starts to get phased out, you got to look in your software to protect that QBI deduction, and make sure that the original purchase price, or the basis, I should say, of the property. So not not after all the depreciation, the basis, but the original basis of purchase price plus the undeducted closing costs, right? Make sure it's properly in the software for these higher income clients, because that will actually a lot of times will kick in and give some of the qualified business income, where if you don't have anything in this box, or if it's not correctly drawing that UBIA data into your software, it will deny or reduce the QBI deduction. So if you kind of haven't done the initial studying on what the UBIA is, but this is actually one situation where it does come into play quite a bit for higher income clients who are facing a QBI deduction phase out. So hopefully that is sufficiently wordy. But and then what about these other boxes, right? What about these other boxes that they seem to never matter, like aggregation, right? Again, you can study that, QBI aggregation, this, that, but barely ever see it, except if somebody, in certain situations. But with real estate, right, a lot of times what happens is people have one rental property, then they have two, then they have three, then they have four, then they have five, they have 10. So the option to aggregate rental real estate is probably the most used area of aggregation for QBI. And so if there is an advantage to having that UBIA, or even the W-2 wages limitation, if there's an advantage to treating multiple rental properties, right, or multiple businesses that are related to real estate, or just you can make some case for aggregating them under the aggregation rules. Again, it's about protecting and maximizing that QBI deduction. And so you can make an election with regard to particular rental properties to include that with other rental properties, potentially with other businesses that maybe are related, like a real estate management business, property management business. And so, yes, aggregation rarely matters, but it does come into play sometimes with QBI and the QBI deduction related to rental real estate. So something to kind of keep an eye out for. Another thing that you've seen in the fact of preparing these landlord tax returns and rental real estate tax returns after the QBI deduction was put in is that you may not always want to have a rental real estate activity be classified as qualified business income, right? Because a lot of times rentals, because of depreciation, et cetera, a lot of times have a loss, right? And so one of the tricky things about once we, if we go and we check that box, right, and we classify the rental income as qualified business income, that can actually negatively impact the taxpayer and the client um, in the current year or in the future year. So, for example, let's say this is a $51,000 loss on a Schedule E, right, or from even a couple different properties, rental properties, and that is counted as qualified business income. This is a kind of screenshot from Form 8995, right? The qualified business income calculation. And so that's going to actually generate a carryover loss, a carry forward loss of qualified business income. And so kind of the long story short of that would be, hey, what if you come the next year, right? The client comes the next year with a Schedule C business, right? Or some other activity that they would certainly want to have the QBI deduction for that $51,000. But if they're carrying a loss from a rental property from the year before, that is going to, counteract their qualified business income in the future year, right? And so that's kind of an example where we may not want the rental income to be counted as QBI if it's generating a loss, right? And this is kind of a screenshot of how that might work, right? Is let's say you have a Schedule C where the qualified business income normally would be 184 grand, right? So you're thinking, okay, 20%, I'm going to try to go for a 20% QBI deduction, so that'd be a really nice deduction, right? But when you're adding on a negative 60,000 of rental loss, right? And you can see that in the little arrow on the right there that the qualified business income is quite reduced by that treatment, right? And so this may, kind of get us to thinking, because we're tax people, is the kind of thing that we think about, right? Is, okay, what if I'm watching this training video or just, kind of like having trouble sleeping at night and I start thinking about kind of things that maybe I didn't have the best treatment. Maybe I should have classified rental income as QBI for a particular client or set of clients, right? Or the other way around. Maybe I counted it as QBI and the rentals were generating losses, and I know that those clients have business income. So now I'm watching this training video and I'm concerned because maybe I should have marked it that it was not qualified business income. So can I amend past year returns to choose the more favorable treatment? Well, I haven't seen anything if that's happened where IRS has not allowed that. They really seem to be pretty liberal about what you can do with this thing. That being said, we don't know if that'll always be the case. So it's not really a recommendation either way, but it's definitely something that some people may be thinking about as we're watching this video. And then what about if you want to change the treatment from year to year, depending on what's more favorable, right? So maybe in the early years when a rental property is not giving off a profit, you're like, and the taxpayer also has a business, the client has a business. Well, I don't want to reduce the QBI deduction on the business income by marking the rental income as QBI income because of what we just saw, right? That right there. So let me just say that it's not QBI income for those years. But then once the rental property goes profitable, maybe I'd like to have that, QBI deduction on that, right? And so is that permissible to kind of like have it from year to year depending on what's more favorable? And so something to think about in that area might be, that pulling back to that big picture, right? That big picture of so pulling back to that big picture of when in doubt, those section 172 or 162 tests apply. So was there a good faith intention to earn a profit, and was the taxpayer engaged in this activity on a regular and continuous basis. So if something about that changed, right, from year to year, then maybe there may be some justification for having some different treatment of a particular rental property. 1 year QBI, yes, the other year, no. But it kind of is a little bit tricky, right? And there should be some kind of reasoning, right? Like the taxpayer then got a property manager, right? So they no longer were really engaged in the activity on a regular and continuous basis. So again, just as always, kind of trying to keep our minds sharp for these various situations that come up in the tax world. And so hopefully this video puts you on that wavelength. And as always, if you have something to add, something to say that we did it wrong or we did it right or you hate it or you love it or whatever, always love to see your comments on our training videos and just kind of let us know what you think. We care what you think, and hopefully this is helpful to you. We'll see you soon.